Here's what's coming up on today's show.
Any kind of tool that you're seeing that's available to you to make investment decisions based on AI is probably a few weeks to a few months old. And that's not enough data to know how it's going to perform.
This is the Retire Happy podcast with John Amarino, a fiduciary financial advisor at Securus Financial in the San Diego area, and Thomas O'Connell, president of International Financial Advisory Group, Inc. in Parsippany, New Jersey. Together, they'll be keeping retirement happy from coast to coast.
Welcome back to another episode of the Retire Happy podcast. I'm your host on the West Coast, John Marino, and I am joined, as always, by my good friend and co-host on the East Coast, Mr. Tom O'Connell. Tommy, how you doing?
I'm doing great, John. Nice long weekend. How about you? I got my daughter off to college.
Yeah, how is that?
Nester now, except for the dog.
How was the move-in?
It was actually very good. The kids at school made it very simple for the incoming freshmen. I was in and out of there. It was great. Yeah, no, and she's had her first full week there. As a matter of fact, I ran into her at Yankee Stadium on Sunday, believe it or not. We both went to the game unknowing each of the other was going. And it was a great game up until the seventh inning when the Yankees pitching blew up. But that's kind of typical.
No, that's awesome. That's awesome. And you're less than an hour from her anyways, though, no?
About an hour without traffic. So it's not bad.
Nice.
I hear Jake smoked it this weekend.
Yeah. So we had a Labor Day turn up in Orange County. So we ended up getting a hotel up in Laguna, Dana Point, Laguna Cliffs. It was beautiful.
Oh, nice.
And
I love that place.
He's still, he's 11 and a half. They had him playing hopefully in his last 13U tournament for a while, and then he'll focus on his 12U team. But yeah, he hit leadoff for most of the tournament. He ended up hitting 333, but defense, I've had parents just talk about his defense has just been awesome. This is the third straight airless tournament he had, and he's playing short and third base. And I know you saw my little post on Facebook. I don't post much, but he made this unbelievable dive up the middle.
So that very Derek Jeter-esque.
Yeah. So he's doing good, and him and his best friend. It's cool because they're the two youngest players on the 13U team, definitely, but even on their normal team, and their coach loves them. But they just both have unbelievable work ethic. It's even something I can take into heart, like when I'm feeling those weeks where you're just not feeling it, Tommy, and I look at him and I'm like, the kid's just got no quit in him. So we're gonna be I've got field passes for the Tigers, and one of his favorite players is Kerry Carpenter. So hopefully we'll get to meet Kerry on Thursday.
Cool. All right. Awesome.
So, yeah. So, folks, we always look to bring in experts in a lot of areas. And, normally we have Mark DiOrio talking about markets and whatnot, the chief investment officer of our firm, Brookstone Capital Management. But there's also a growing, a surge in AI, and how that's going to start shaping the investment landscape. Obviously, a lot of tech companies like NVIDIA have had huge years. So Tom and I wanted to bring in an expert who really has almost 2 decades of AI experience. And our expert today is a co-founder and chief investment officer of Markin Asset Management. And he is the head of research and portfolio management, and his expertise really goes and transcends traditional methods. And within that, he has been at the forefront of utilizing AI to enhance investment strategies. So David Marra, who is our guest, has over 3 decades in the financial world. He's recognized for his ability to take extremely complex investment concepts and make them accessible to clients and advisors alike. And, he's really been a huge influence around the financial industry. And we are excited to have David. one other thing, he's been the founder and CEO of a search engine technology firm. And when we were talking to David before, he was telling me he's got about 20 years of AI experience. I didn't even know AI, for that matter, was around. So we are really, really excited about hearing how David uses AI and what is the future of AI. So without further ado, I'd like to introduce Mr. David Marra.
Today's guest, the co-founder and chief investment officer of Markin Asset Management, it's David Marra.
Hi, John. Hi, Tom. It's nice to be with you.
Thanks for taking the time to join us today, David.
It's my pleasure.
Thank you. So, David, you've had 30 years in the financial industry and in asset management. And now, 20 of those with AI. Can you kind of tell us where your journey began with AI and investing?
Yeah, sure. So, just on AI to set the time frame for AI itself, the type of AI that is making all the news today, it's only been around as a technology now for a year and a half, but the underlying models, what were created by mathematicians back in the 1960s, and the underlying statistics, the underlying models, the underlying theory, all of that is from the 1960s. We didn't have the compute power that we have today, or the data that we had, digital data that we had today back then. But the underlying sort of the stage was set back in the 60s to usher in the reality that we have today with AI. My own journey with AI starts really after business school. As I mentioned earlier, I did my graduate work in finance at the University of Chicago. And it was 3 years out of Chicago. I was doing management consulting. And it was the late 90s. And I got thinking, it's the Wild West of internet search engines back then. We had all these different search engines. Google had not established its dominance yet. And I started a search engine company in Japan, actually. And, very quickly had about 75 people working for me, building technology. And those, search engines is about ranking things, it's using data to rank things. And that really started, that was a seminal event in my career, because it gave me a passion and an understanding for seeing how technology, specifically compute, algorithms, and data can come together to do really amazing things. And then a few years after that venture, that was the late 90s, early 2000s, I started to think about how I could start to use those three things, compute, data, and algorithms, to invest more wisely, invest using, what we call today systematic or quantitative investment techniques. And in 2010, I founded my second startup. And this time it was a quantitative investment research firm. And we were building trading strategies for institutional managers, hedge funds, and other quantitative type of managers. And then about 4 years ago, my partner, Matt Kinzer, and I formed Markin Asset Management to bring, these quantitatively managed strategies to advisors and, everyday people, saving for retirement, for example. So that's the short version of the journey.
Wow. So, AI going back, and you obviously having, roles in developing search engines and very advanced things like that. Where do you see AI in today's market and kind of the future? If you could kind of just expand on what and where you've seen it been and where it's going now.
So that's a big question. We think there's a lot of opportunity for investors to profit from what we view as a secular change in technology. Secular meaning, a long-term kind of shift in technology that AI is bringing about. So we think that the AI theme as an investment theme is spawning a very new and very different ecosystem of lots of companies that people can invest in, and many of these companies are listed, that people can invest in and profit from. That's point one. Point two would be, not only is sort of the AI technology space an interesting place for long-term investors, but also, of course, companies in every industry their businesses and their business models are being changed by how they can use AI to do things in every industry, to sell consumer products, or to create energy, or to the communication space, the industrial services space. Essentially, every industry is being touched by the productivity enhancements that AI can bring about. So yeah, we think there's a lot to invest in that's affected by AI, and that's why we've built particular investment strategies around investing in, for example, AI beneficiaries that I was just speaking to, or investing in AI technology companies.
So your focus is on retirees and retirement planning, as is ours, and that was one of the things that really interested us in speaking with you. What would you say are maybe some of the highlights and some of the lowlights of what AI has brought to retirement planning, and then maybe more specifically to the investment opportunities that your firm has or you're finding through the use of the technology?
Yeah, sure. That's a great question, Tom. The way that we think about retirement is, it's a long period of time, typically 20 years, but it can be as long as 40 years, with, people living longer and longer. And I think we all know people in our daily lives, in our families, and in our friends who, have older people in their family. I can think of multiple people in my sort of extended family and friends kind of group that are well into their 90s, over 93, several examples in my family. And, lifetimes are just getting longer, and healthy lifetimes too. So people are going to consume for longer periods of time. And we have to think about, as financial investors, asset managers, how we can build investment products that are going to deliver income over long periods of time. And the mathematics of income are very different from the mathematics of return. When you're in the accumulation phase of your life, return relative to risk-adjusted return, there are multiple measures of that, but risk-adjusted return is a good measure of how you're doing, right? And then you got to figure out, how much income you're going to want and for how long you're going to want it. But return is a good measure when you're accumulating, risk-adjusted return. When we get into the retirement phase of our lives, we really have to think about income. How many years can I write a check to myself every month indexed for inflation?
Right.
And those mathematics are just completely different from return, which is why we use simulation technologies and other tools to estimate at a high degree of probability I can write that check for me indexed for inflation for as many years as I think I'm going to need it. And so we take those mathematics as a function, right? We're going to look at that as a function. We can code that as a function, that writing a check every month, rest of my life, indexed for inflation. We can turn that into a function. And then we can get our investments to now work toward optimizing that function. And when we do that, we find a few things. We find out that return is less important than it used to be, and risk is a lot more important than it used to be, because you need to be able to write that check every single month, no matter what markets are doing. And if we go back to, say, 2022, the most recent, kind of market pullback, the 60-40 portfolio in that year was down about 16.5% or so, depending on how you measure it. The average retail investor in 2022 this is North American retail investor, was down 35% in that year.
Wow.
Yeah. Which shows you how much additional risk the average person is taking on in their kind of own monies that they're managing. And that's simply not acceptable for a retiree. You couldn't be down 35%. You'd have to dramatically cut, that monthly check to be able to preserve future income, were you down something like that. So that's kind of a long way of saying, retirement has a very different set of mathematical properties, and therefore we need to manage portfolios, of course, taking into account return, but much more focusing on making sure that we don't have large drawdowns. So that's kind of the first part of the answer, I would say.
Well, you know what I love about that, David, is, I mean, you speak from quants and very technical, data-driven analysis where we're removing emotion. And we know through studies from MIT's Dalbar that emotion plays a huge role in investors, performance. And, I think it's like an echo chamber in here, Tommy, which, you have just nailed from a technical standpoint, a mathematical standpoint, what Tommy and I preach about all the time to our clients and our listeners, that distribution is absolutely different than accumulation. And, there's a lot more risks involved. And, that where it comes, to sequence of returns risks, emotional risks, the psychological effects of now spending from your savings and depending on that. So, I mean, that was huge. One question I have is getting back to AI investing is, a lot of the AI stuff is with the NASDAQ, and obviously with your expertise and understanding the risks that, retirees can't take. How do you see with investing in AI, because you guys do a lot of that, in terms of AI being a traditionally volatile investment, how today's retiree could put that into their portfolio?
So we have to be very, as we're discussing, we have to be very careful and attuned to the risks. And we're going to fit AI as a technology investment is going to fit into the growth portion of somebody's portfolio. And this is kind of one approach that we're taking. And because these things depend on, it varies depending on what the type of portfolio is and how much risk the portfolio is allowed to have. So we manage multiple portfolios, but just to give you the gist of it. So AI is a secular trend. It's a long-term trend. We don't think, markets will go up and down. But we think that the productivity benefits that it's bringing about are real when we look at the data. We see those, and some of that data comes from MIT, as you mentioned, John. And we think that AI as a technology really has, and the studies are showing this, that it really does bring about productivity gains. And therefore, if those gains play out, the technology companies are going to profit. But it's volatile. So how can we sort of adjust for that for the retiree? Well, one thing we're doing is we have a portfolio, for example, where we combine what we think are the two big secular technology changes going on right now, secular innovations. One is AI. The other is GLP-1s. GLP-1s, for any of your listeners who aren't familiar, is the kind of technical reference to the weight loss drugs. But we don't call them the weight loss drugs because we use the technical term, the GLP-1, instead, because those drugs are proving to have applications across many different diseases. I'll go into that later. Coming back to the main point, we can take AI, which has its own kind of volatility and its own set of correlations, and then we can take the GLP-1 ecosystem of innovation, the healthcare ecosystem of innovation, and we combine the two in a single portfolio. They have a very different correlation structure. What that means is when AI technology stocks tend to be up, healthcare stocks will tend to be down, and vice versa. They sort of counterbalance each other quite nicely. With that portfolio, you look at technology stocks, you're going to have a beta, a variance to the market. Think of it as like leverage of about 1.3 times or 1.4 times. But when we bring in technology, healthcare innovation into the same portfolio, we can get the same beta, the same variation, the same volatility as that of the overall market, the overall equity market. So dramatically lowering the volatility exposure in the portfolio if you had just invested in AI stocks, for example. So a portfolio with AI stocks and healthcare innovation stocks combined, we can get that volatility down to the same volatility as the market. And therefore, that's going to slot very nicely into somebody's growth portion or equity side of their portfolio. And it's going to expose them to two very innovative sectors of the economy, which we certainly hope and believe are going to have greater, long-term returns.
So if I could, I'd like to jump back to the income side of the discussion, because that's something that I emphasize strongly with clients, as I know John does. One of the things I always ask clients or prospective clients is, hey, do you want to be rich, or do you want to make sure you never run out of money? Now, a 10-year retirement and a 40-year retirement are different, obviously. How do you look at, I would imagine that over that span of time, you are building a model that's different, a 10-year outlook and a 40-year outlook and whatever in between, or are you not? Or does AI help you adjust to that? And the reason I ask is because, like you said, people in your 90s, right? And there are studies out there saying that the first person to live to 150 is alive today. So how do we, say, as advisors, look at a retirement portfolio creation that we know can last, say, 30 or 40 years? I hope I'm making sense with that question.
Yeah, sure, Tom. Obviously, the mathematics are not going to change, and you're absolutely correct that the shorter the retirement horizon, even more attention we have to pay to risk, because you've got less time to recover. I mean, to put it in simple terms, you've got less time to recover if you get a severe loss of capital. So typically, we would handle that in the standard industry way with a what's known as a glide path often, which is that your risk budget, the amount of risk you're willing to take, declines as you get older. You want to have less volatility, less risk in your portfolio as you get older. So we can handle that through a glide path, and everybody's glide path will be different depending on their circumstances. But if you're looking at a pool of people, you're looking at kind of an average there. How AI can play into it is simply give you what we're looking for it to do. AI and GLP-1s we're looking for you to get a better risk-adjusted return from that portion, from that growth, just that growth portion of your portfolio, so that you can potentially take less risk in that growth portion of your portfolio, but get a higher return. Meaning, put it in technical terms, you're getting a little bit more alpha out of that growth portion of your portfolio. You can exploit that alpha. You could take that alpha in terms of more return, but if you're in retirement, a probably smarter approach for most people is going to be to take less risk and lower your exposure to tech overall, and use that alpha, that additional return that you're getting, to actually take some risk off. So just like some concrete examples, we often see people's portfolios, as they kind of come in the door to us, the way we see them. And again, primarily we work with advisors. So the client is the advisor, and we're providing the investment strategy. But you look at some of these portfolios, and somebody's just invested in Nvidia and Google and Microsoft and a couple other names, and they think they have an AI portfolio. Well, they have a very, very risky AI portfolio if you're invested in just this handful of high-flying stocks. Our AI portfolio, I think, has over 60 stocks in it at this point. And the purpose of that is to diversify away the risk as much as possible. So, these are basic things that we use quantitative techniques for, but the basic underlying ideas still apply. They go back to Markowitz and his 1952 paper that started modern portfolio theory. Diversification. You want to have a very well diversified portfolio. In so doing, I can reduce the volatility and the risks in that portfolio. And that's something as a retiree, I certainly want to do.
Yeah. Yeah. And, I've found it pretty interesting when, we, right before Tommy's question about how you're taking these two sectors and being non-correlated and be able to, balance them against each other, which is, the most traditional example of that would be, the stock bond theory. So if I could follow up on that point made earlier, if we had a systemic market correction, would both of those sectors, how would both those sectors, would the correlation then come into play?
It certainly depends on the type of correction, but in the kind of classic kind of think, global financial crisis, Lehman crisis type of correction, which, by the way, economists estimate you get a correction like that, you have about a 30% chance of getting a correction like that about once every 10 years.
Right.
John, as you're pointing out by asking the question, that's a lot, right? Every 10 years, you got a 30% chance. And we're talking about retirements here that are 30 years. So each 10-year period, a 30% chance, do the math, so to speak. There's a lot of risk there of having a correction like that over the course of a retirement. So back to your question, John, how do we handle, and prepare for corrections like that? There are obviously a variety of tools. There's no one tool, and that's what makes portfolio management interesting, is there's no one silver bullet that's going to protect a portfolio. What we're trying to do is build a really robust big toolkit that we can have a bunch of tools that are going to work with higher degrees of probability or less degrees of probability depending on the situation. In the classic type of growth shock simulation, 2006, Lehman crisis, global financial crisis, that's a growth shock type of scenario. Early COVID days was also a growth shock scenario. You're typically going to have technology stocks perform poorly in certainly in the early days of that and into the trough of that, whereas healthcare stocks are typically going to perform much better because there's demand for healthcare regardless of what's going on in the economy. So that would be in a typical growth shock, a negative shock to growth. Having that healthcare portion is going to what's going to help hold that portion of the portfolio up.
That's very interesting.
So in the development of your portfolios, and I'm not trying to put words in your mouth, I'm just trying to make sure I understand it in the audience. So in the development of your company portfolios that you're building, you're more concentrating on equities and diversification and reducing that risk, or are you including income as part of that portfolio?
So, Tom, obviously we have multiple strategies that I manage. I think I manage, make sure I get the number right here. I manage 7 strategies today.
Okay.
So there are different objectives for different strategies. For 4 of those, which are not, these are outside of the AI and GLP-1 innovation spaces, we call these return and yield strategies, right? For our return and yield strategies, what we're definitely managed into is what I talked about earlier, which is maximizing the total amount of income. Equivalently, the term is yield or income, either word is equivalent here. But maximizing the total amount of income somebody can get out of a portfolio over a period of time. And then we have 4 of them because there are different lengths of retirement, or equivalently, there are different levels of risk that somebody can take.
And that's your glide path that you were mentioning before.
Yes, using those 4 strategies, we can create pretty much any different percentages of those strategies. We can pretty much manage to any kind of glide path that we would, want to build.
Mm-hmm. Okay, that makes sense.
So, go ahead, Dave.
Oh, I know. I was just going to say those portfolios are built with a mix of, multiple asset classes. So domestic equities, international equities, domestic bonds, treasury bonds, corporate bonds, and then some precious metals as well. So we're looking for, again, diversification, lots of asset classes that we can choose to use or not use, and then to different degrees so that we can constantly stay on top of managing those risks that are so important.
Outstanding. So in closing here, and we've talked a lot about, diversification, AI, for a lot of our listeners, some of them are do-it-yourselfers. And, when you hear a very well-versed guest like yourself, and, you realize investing is not easy. There is a lot of complexities that go into it. It's not as easy as watching CNBC or Fox News or subscribing to a newsletter. So I really think a lot of people in my conversations are going to start to turn to AI as their new, Fox business. Can you kind of tell us about where AI is in the investment advice world, and some things that people who are really going to try to lean on AI that they have to be aware of?
I think if we're talking about the kinds of AI investment tools that you're seeing, pop up sort of every day for the average, investor, not specialized tools for institutions and these kinds of things, but these kind of retail AI kind of based tools. Me personally, I think that that would be very dangerous type of investing. And I certainly would not encourage it. I wouldn't do it myself if I was non-technical. AI is the current generation of AI, which they call generative AI, right? Gen AI or generative AI, is very new. It's actually only been around a year and a half. It builds on these tools going back to the 1960s, but the kind of latest version of the technology has only really been around a year and a half. And if you extend it out to 2 years, kind of in the lab for 2 years, so to speak, that's it. Any kind of tool that you're seeing that's available to you to make investment decisions based on AI is probably a few weeks to a few months old. And that's not enough data to know how it's going to perform. It would be very, very dangerous, I think, to risk your retirement on these kinds of tools. I think the professional class of asset managers like myself, and then advisors like yourselves who help people, who kind of sort through all these things for people, is, like you pointed out, it's an extraordinarily complicated world, and investing is complicated. And it's worth finding an advisor who you trust to help you figure out what the best plan is for you and make sure it's customized for you. And then those advisors are plugged into people like myself, who is an asset manager, a fund manager, and then can select the best of us to try to manage those risks, for people day in and day out. I mean, that's my recommendation to the retail investor. And just going back to the data, I pointed out 2022, the 60/40 portfolio, which in and of itself doesn't manage anything for retirement. Just make that clear. That's an interesting discussion to have. It's, 60/40 is not actually built to that function of the retiree. It's just an allocation, but it's often used as a benchmark. But, that's a year when a portfolio like that was down a lot, 16.5%. Nobody expects their very safe 60/40 portfolio to be down 16.5% in a year. But the retail investor was down 35%. Why? Well, they're taking on more risk and some other factors. They may have bad market timing. They may be very emotional. There's other things that may go into it. But I think a lot of it also is they're taking on a lot of risk. These are things that the professional investment community can kind of help you avoid. And then just, it's at some point in time, I mean, I know myself, I've thoroughly enjoyed my career as a quant fund manager, but at some point, I'm not going to be able to do it anymore, right? And I'm going to rely on professionals to make my decisions for me. I mean, it's a full-time job for me to do what I do. I can't imagine what it's like for somebody trying to manage their own portfolio when they're trying to enjoy their retirement. It just sort of seems crazy.
Yeah.
I see this being 2000 all over again, where all these technology companies come out, and I don't know if I can call out any of them, but they have no experience, they have no product, They have no balance sheets, right? But everybody wants to invest in them because it's a incredible concept. And that's what I see the current AI that's being marketed to the general public. And people are going to get crushed because they have this confidence in something that isn't even proven, like you were saying, David, in a retail sense, not in a big quantitative sense. And I mean, I could see this being a disaster, like 2000, 2001, all over again, for the mom and pop who are trying to do something themselves, or who have a 20-year-old broker who is just taking orders, right? And I just see this thing being a mess all over again.
Yeah, I mean, to your point, Tom, I mean, Gene Fama was, one of my lecturers at the University of Chicago, won the Nobel for asset management a number of years ago. And we students used to ask Gene, how much data is enough data when it comes to financial returns, when you're building a model? And he would always answer that question by saying, well, how much data have you got?
Mm-hmm.
And how much we have for North America is around 100, 120 years. And that's what he meant when he said that, meaning it's when you have a very short amount of data, just, let's use the recent bout of inflation, for example. If you were using a model that had only 20 years of data in it, when this bout of post-COVID inflation started, you would have had a model that had no inflation in your data if you had 20 years. We use models that have about 90 years of data. So we had lots of inflation, bouts of inflation in our models, and is one of the reasons we kind of, did well through that bout, because our models were telling us, inflation's here and you're going to have to change things up. But my point is that even with 20 years of data, market cycles are very long. Even with 100 years of data, you've only got about 5 or 6 different cycles in there. And it's still too little data to use 20 years of data. So, if you're looking at some retail AI model that's who knows how much data has been in there, and the model itself, meaning the way the model works, the technology that's driving the model, is only a few months or a year old, you're dealing with a lot of uncertainty.
Yeah, because they're in the old market timing days, right? They would say, well, we back tested it from past cycles and things like that. But the retail investor, the average mom and pop, they don't know where they're falling in on that cycle, right? That cycle that they're talking about, that they back tested it in, they could have been in the middle of it or at the very end of it when they actually get into it. So all that data, I think, to your point, really is useless because it's tested in a cycle that you're not even experiencing. Am I off?
Well, we think data is useful, and
Yeah, I'm not saying data is not useful, but I think the way that some people depend on it.
that's right. You have to be, the reason why it's a highly technical field is there's a lot of technical things that go into building a good model, which will give you a good picture of, investing is like constantly being in the fog of war. It's always a thick fog, right? You think about where we're sitting here today. You can, I get up about, I start doing my reading in the morning, and I've probably done about 2 hours, 2.5 hours of reading before markets open, right? Reading analyst reports, reading the news, looking at what our models are saying, et cetera. And on any particular day, I can read as many articles are telling me the market's going to go up as many articles just say it's going to go down.
Yeah.
And that's why we build models, to give us our own proprietary insight into what we think is actually going on through that fog of war. But my point is, the fog is always thick.
Yeah.
There's always a lot of uncertainty about what's about to happen and what's going to happen. And therefore, using a lot of data about the past, as much as we have available, good data, does help us to think through what are the types of scenarios, what are the probabilities on those scenarios, and therefore, what's the best thing to do.
Excellent.
And so in our closing, if you could just give us a couple minutes, being that, you're a well-versed fund manager. We're going into everybody's least favorite month of the year, September. And we're also, towards the end of a positive market trend. What's your outtake on the market as a whole, kind of going forward here?
So I think what we know is that global growth, including U.S. growth, is declining. We've had an incredible amount of federal government spending, fiscal stimulus. You could call it deficit spending if you want to, because that's also what it is. That has kept the U.S. Market growing quite well through it. Really, the best in the world is not an exaggeration. But that stimulus, is slowly coming down. There's still a lot of infrastructure stimulus out there and things, but it's slowly coming down. Also, just the post-COVID drivers are coming back to normal. That's good for inflation. It's bad for growth. So that all we know. What we don't know is, where does the growth stop? Do we kind of get to a happy medium and we're back to kind of a pre-COVID type of healthy, but not overly healthy kind of growth market? Or is this growth declining so fast that we're going to overshoot and kind of go into soft landing, or worse, as a recession? So those are probabilities that we have to look at every day based on, all this information about economies and things that we look at. But where I come out is I want to invest in the parts of the market that are likely to grow the best. We're not going to know. I can't sit here today saying I know markets are headed down or markets are headed up. But what I can say is growth is coming down, and I want to have a diversified portfolio of things that are likely to have higher growth than other things. And there, where I'm looking for companies that are implementing artificial intelligence to drive earnings and to drive productivity growth. I'm looking for superior returns from companies who are building those technologies. I'm looking for innovation from GLP-1s and the ecosystem around that, which are providing positive outcomes for Alzheimer's patients, for obviously weight loss patients, for heart attack outcomes, for kidney disease outcomes. I mean, it's proving itself in these multiple areas. So that's a broad-based technology that should be able to deliver, relative to other things, superior return through lower economic growth. That's how we kind of think about it. And then layered on top of that is all the other things we talked about, just good diversification, constantly watching the risks and managing to risks, which includes all those elements of, bond allocation to precious metals and other commodities and different types of equities.
Awesome. The key word there, diversification. It's, the market mantra that never feels good, but has proven to be, over the course of decades, a proven strategy. So, David, that was a wealth of knowledge. What do you say, Tommy?
That was awesome. This isn't something that we get to talk about a lot, but it's something that both of us love to talk about. So we really appreciate the hour that you've taken to speak with us and to our listeners, David.
Well, thank you so much for having me on your show, and I hope your listeners get something useful out of it. It's a pleasure to be here.
And if you really enjoyed this, I really encourage all the listeners to go on to markinfunds.com, and we'll have the link in the show notes. And you guys have an insights blog, is that correct, David?
Yes, we do. Yeah, it's for advisors and for individuals, both.
Yeah. I mean, we do not want to be following the mainstream media narrative. These are the type of people, folks, you want to follow. You want to get good market analysis. We need to start reading blogs by people like David Marra. So, David, I appreciate you spending your valuable time to educate our listeners. And I love the fact that you're mixing the investment world with the retirement world, because that's what Tommy and I are all about, is the Retire Happy podcast and letting people enjoy the retirements they deserve. So folks, that's going to wrap it up. for today's show. And, we look forward to having more guests to help you retire on happy. Until next time, take care, folks.
It's easy to get in touch with John and Thomas. If you're more on the West Coast, give John a call at 858-758-9889. That's 858-758-9889. Or go online to GoSecurus.com. That's GoSecurus.com. If you're more of an East Coaster, then call Thomas, 973-394-0623. That's 973-394-0623. And online at internationalfinancial.com. That's internationalfinancial.com. And you can, of course, always just check the description of today's show for all that contact information. Don't forget to subscribe and follow the podcast on your favorite apps, and we'll see you next time on the Retire Happy Podcast.
Investment advisory services offered through Brookstone Capital Management, LLC BCM, a registered investment advisor. BCM, Securus Financial, and International Financial Advisory Group are independent of each other. Insurance products and services are not offered through BCM, but are offered and sold through individually licensed and appointed agents. The opinions expressed by John Iamarino, Thomas O'Connell, and guests on this show are their own and are based upon information considered reliable, although it should not be relied upon as such. Any statements or opinions are subject to change without notice. Investments involve risk and, unless otherwise stated, are not guaranteed. Past performance cannot be used as an indicator to determine future results. Any strategies mentioned may not be suitable for everyone. Information expressed does not take into account your specific situation or objectives and is not intended as recommendations appropriate for you. Before acting on any information mentioned, please consult with a qualified tax or investment advisor to determine if it is suitable for your specific situation. This program is designed to provide accurate and authoritative information with regard to the subjects covered. Registered investment advisors and investment advisor representatives act as fiduciaries for all of our investment management clients. We have an obligation to act in the best interests of our clients and to make full disclosure of any conflicts of interest, if any exist. Please refer to our firm brochure, the ADV 2A Item 4, for additional information.